Ever wonder how major airlines manage to lock in their jet fuel prices months in advance? Or how, a regular person sitting at their laptop can trade a fraction of the entire S&P 500 without ever actually buying a single share of stock?
Yeah, I mean, from the outside, it honestly looks like a magic trick. You just see these massive numbers moving on a screen.
Right, just flashing red green all day.
Exactly. But underneath all that flashing is the actual engine running the global financial system.
Well, welcome to today's deep dive. We've got our hands on a pretty dense, highly technical guide covering financial derivatives, and our mission today is to take these seemingly opaque market mechanics and just entirely demystify them for you.
Yeah, because we hear these terms constantly, right? Futures, options, margins, derivatives.
Oh, all the time.
Yeah.
And it often feels like this exclusionary language, like it's designed to keep everyday people out. So we're going to translate it. We're going to unpack the architecture of this system so that by the end of our conversation, it makes complete intuitive sense to you.
And I think the most logical place to begin is by looking at the core premise established in our source text. It states quite plainly that derivatives are simply legal agreements.
Okay, legal agreements, not actual things.
Right, exactly. When you're in this market, you are not trading physical assets. You aren't buying a tangible piece of a company. You're basically trading price movements and time. The instrument itself, it derives its value entirely from the performance of an underlying entity.
Let's ground that in reality for a second, because this conceptual leap is usually where people get lost. Like, if I buy an equity or share of a company, I own a tiny fractional piece of that business, right?
You have a slice of the pie.
Right. But trading a derivative requires a totally different mental model. It's less about owning the pie and more about securing a guarantee.
That's a great way to put it.
It's like paying a bakery $5 today for a coupon that guarantees you can buy a custom wedding cake for $100 next month, no matter what happens to the global price of sugar or flour between now and then.
Yeah, exactly. You don't own the cake yet, but you own the right to that specific price. The contract itself is the asset.
Right.
It defines specific rights, or in some cases, strict obligations regarding that underlying entity, which, could be an index, a commodity like gold, or even a currency.
But if I'm a listener who just wants to invest, an obvious problem jumps out here. If I don't actually own the asset, why jump through these hoops at all? I mean, if I think the price of oil is going up, why not just buy a barrel of crude oil and leave it in my garage?
Well, mostly because of the logistics of scale and the absolute necessity for liquidity.
Meaning it's just too hard to move the physical stuff around.
Exactly. Historically, if a commercial entity wanted to buy a massive amount of an asset at a future date, they had to draft a private, bespoke agreement with a supplier. That is incredibly messy.
I can imagine. You'd have lawyers arguing over every detail.
Oh, for sure. It's difficult to find a specific counterparty who wants to buy or sell the exact amount you need, at the exact time you need it, and at a price you both agree on. So regulated exchanges like the Chicago Mercantile Exchange stepped in to solve this structural inefficiency.
And they did that by creating futures contracts, right?
Yes, they stepped in and basically took all the negotiation out of the equation. They enforce strict standardization.
They dictate every single variable except the price itself. So every contract for a specific asset becomes identical.
Precisely. The exchange determines the quantities, the specific quality grades of the commodity, and the exact delivery dates.
The source text uses crude oil as a prime example here, right?
Yeah, it notes that every single standard crude oil futures contract represents exactly 1,000 barrels, no exceptions.
Wow, okay, 1,000. So this total uniformity means buyers and sellers don't have to bicker over the terms anymore. They only have to focus on price discovery.
Right, which creates a massive pool of participants trading the exact same thing, making it incredibly easy to enter or exit a position. When you buy a futures contract, the text refers to this as going long, meaning your profit target relies on the price increasing.
And when you sell a futures contract to open a new position, you're going short, targeting a price decrease. But, and this is fascinating, the mechanics of how these contracts are birthed is wild. The market doesn't just print them out of thin air, does it?
No, it doesn't. A futures contract requires a willing buyer and a willing seller to match up. It is a pure zero-sum environment.
Zero sum. So for every dollar made by one trader going long, a dollar is lost by the trader who went short on the other side of that specific contract.
Exactly. There's no external value being created out of nowhere. It's just capital transferring between accounts based on who was right about the future price.
Okay, let's just pause and consider the scale of what you just described. Because, I mean, if every oil contract is 1,000 barrels, and this is a strict zero-sum game against whoever is on the other side, that is terrifying for an individual.
Oh, absolutely.
Like, the person on the other side of my trade might be a multi-billion-dollar hedge fund. The capital requirements to play in that arena, where a tiny price swing on 1,000 barrels could wipe out a normal bank account, they just seem insurmountable for a regular person.
And you're completely right. For a very long time, it was an exclusive playground for institutional players for that exact reason. Regular people just didn't have the capital.
So how did retail traders even get involved?
Well, markets are highly adaptable ecosystems. To capture the retail trading demographic, the exchanges engineered an actionable solution, which are called micro-E-mini contracts.
Right, they essentially shrunk the barrier to entry without changing the actual mechanics of the game.
Exactly. They introduced contracts that represent a specific, mathematically fixed fraction of the standard sizes. The source material highlights the micro-E-mini S&P 500.
Okay, and how much smaller is that one?
That contract is engineered to be exactly 1/10 the size of the standard E-mini contract.
So a retail trader gets to participate in the exact same price movements using the exact same data, but their financial exposure per point of movement is drastically reduced. It's essentially a mechanism for capital preservation.
Right, it lets you get your feet wet.
Yeah. It's like getting to practice in the shallow end of the pool while still feeling the real current of the ocean. If I'm a beginner transitioning from paper trading, where I've just been, clicking buttons with fake money into the live markets, I can finally experience real market depth without risking my life savings on a single trade.
And the text calls this precise scaling. Because rather than being forced to buy one massive contract that completely violates your personal risk management rules, you can utilize multiple micro contracts to fine-tune your exposure.
So you can scale into a position gradually.
Yeah, or scale out of it as you hit your profit targets, which is a level of nuance retail traders desperately need to survive.
Okay, but to really grasp how this scaling works in practice, I think we need to dive into the specific vocabulary the exchange uses to calculate value. Because if you don't understand the physical mechanics of how a price moves on the screen, you're essentially flying blind.
You really are. You have to look at the anatomy of a price movement, starting with the tick size.
The tick size, which is the absolute minimum increment by which a contract's price can fluctuate, right?
Correct. The exchange hard codes this into the system. A price cannot move by a single penny if the exchange determines the tick size is larger.
Okay, so what is it for the S&P?
In the E-mini S&P 500, the predefined tick size is 0.2, 5 index points.
Meaning the market can tick from 4,000 to 4,000.25 and then to 4,000.50. It physically cannot register a price of 4,000.10.
Exactly. And this tick size directly dictates the real-world dollars leaving or entering your account through what we call the tick value.
So the tick value is the dollar amount assigned to that single minimum fluctuation.
Yes. In the micro E-mini S&P 500, a single tick of 0.25 is worth $1.25 per contract.
Okay, let's walk through a real-world scenario to show how this math cascades for you, the listener. If the tick size is 0.25, it takes 4 of those ticks to make a full 1-point move in the index.
Right. Basic math.
Since each tick is $1.25, a full 1-point move equates to a $5 change in value for that single micro contract.
Exactly. And the source material also mentions the contract multiplier, which is the numerical value you multiply by the current market price to determine the total notional value of the asset you're controlling.
Which introduces the defining and arguably the most dangerous mechanism in the entire derivatives ecosystem, leverage.
Yes. Leverage is the tool that allows a trader to control that massive notional value with a comparatively minuscule amount of upfront capital.
And that small capital requirement is referred to as margin. Now, this is a massive point of confusion. When most people hear the word margin, they relate it to buying a house.
Right, the traditional down payment model.
Yeah. You put down 20% and the bank loans you the rest, charging you interest on the difference. But in the derivatives market, margin is not a down payment. You aren't borrowing the rest of the contract's value from a broker.
No, it functions entirely differently. Margin here is a performance bond.
A performance bond?
Yeah, it's a good faith deposit held in escrow by your broker to prove you can cover any potential losses your position might incur. Leverage amplifies your returns on that small deposit, but it indiscriminately amplifies your losses as well.
So a tiny fractional percentage drop in the underlying asset can translate into a massive percentage loss relative to the margin you originally deposited.
Precisely.
So it sounds less like a down payment on a house and much more like a hyper-strict security deposit on an apartment to prove you're good for any potential damages. But unlike a landlord who might only check the apartment for damage once a year, the broker is monitoring this deposit continuously, right? Using a tiered system.
They absolutely are. The first tier is the initial margin. This is the absolute minimum capital required in your account just to initiate a new position. The broker won't even execute your trade without this cleared capital.
Okay, and then what happens once the trade is live?
Once the trade is live, you fall under the rules of the maintenance margin. This is a slightly lower threshold, but it acts as the absolute floor of equity you must maintain to keep the position open as the market fluctuates.
So what happens mechanically when a trade goes sideways? Let's say I go long on an index, but the market just plummets. My account balance is draining tick by tick, and suddenly I breach that maintenance margin floor.
The system triggers a margin call. Your broker essentially demands that you deposit additional funds immediately to restore your account back up to the initial margin level.
And if I don't, if I can't?
Well, if you fail to wire those funds, or if the market is crashing so violently fast that there isn't even time to ask you for the money, the broker's automated risk systems just take over. They will initiate a forced liquidation of your position.
Ouch. So they step into the market, close your trade at whatever the current market price is, and lock in your losses.
Exactly. They do this to protect themselves, because if your account goes negative, the broker is technically on the hook for the difference.
Man, the rigidity of futures is intense. Both parties are absolutely obligated to fulfill the contract, and if you're wrong, you face the very real threat of automated liquidation and theoretically infinite losses if a market gaps against you.
It's definitely not for the faint of heart.
So if I'm a listener, I'm probably thinking, I want the leverage, but I want my maximum risk capped at a fixed predefined amount. How do I participate without that sort of forced liquidation just hanging over my head?
Well, that's where we pivot from the strict obligations of futures into the asymmetrical mechanics of options.
Options, okay.
Yeah, options are still derivatives. They still derive value from an underlying asset, but their foundational architecture is entirely different. An option grants the holder the right, but notably not the obligation, to buy or sell an asset at a specific price within a strictly defined time frame.
Right, the absence of obligation changes the entire risk profile. The buyer basically holds all the leverage in the decision-making process.
Exactly. But because the buyer holds that power of choice, they must compensate the seller for taking on the reciprocal obligation. The buyer pays an upfront fee called a premium.
Ah, okay.
And the architectural beauty of being an option buyer is that your maximum theoretical loss is hard capped at the exact amount of premium you paid.
So if the market moves violently against you, you simply choose not to exercise your right. The option expires worthless, you lose the premium you paid, but you walk away. There's no maintenance margin call dragging you into infinite debt.
You got it. The source text segments this into two distinct flavors. If you anticipate the market rising, you look at call options.
Calls. Okay, so a call gives you the right to purchase the asset at a predefined strike price.
Right. You profit if the market surges above that strike price plus the premium you paid to get into the trade.
And conversely, if you want to profit from a market drop or maybe protect a portfolio from a crash, you use put options. A put gives you the right to sell the asset at the strike price, banking on the market dropping significantly below it.
Yes, exactly. But the complexity of options lies in how that premium is mathematically calculated. It isn't just an arbitrary number.
Right, there's a formula behind it.
Yeah, the market prices options based on two intertwined components, intrinsic value and extrinsic value. Intrinsic value is the raw, immediate profit you would realize if you exercise the option right this second.
So if you hold a call option granting you the right to buy an index at 4,000 and the index is currently trading at 4,050, your option has 50 points of pure intrinsic value.
Exactly, but the premium you actually pay is almost always higher than just that intrinsic value. The remainder of that cost is the extrinsic value, which the market often refers to as time value.
Extrinsic value. The text talks about this as quantifying hope, right?
That's a great way to put it. It represents the market's mathematical expectation that the asset's price might move even further in your favor before the contract's expiration date arrives.
So a contract with 6 months left on the clock obviously has far more extrinsic value than a contract expiring tomorrow, simply because there's way more time for a volatile, profitable swing to occur.
Right, but time is a depreciating asset. As the clock ticks down toward expiration, that extrinsic value just bleeds out of the premium.
Which creates a logical puzzle here. If the buyer has their risks strictly capped and they hold the ultimate power to just walk away if things go south, why on earth would anyone volunteer to be the seller?
It seems counterintuitive, right?
Totally. Why take on the obligation of potentially having to buy or sell an asset at a terrible price if the market crashes?
Well, the seller, often called the writer of the option, takes on that massive risk specifically to capture the premium, and they do it by weaponizing that time decay we just mentioned.
Oh, okay. So they collect the premium upfront on day one.
Yes. Their thesis is that the market will not move past the strike price before the clock runs out. As every day passes, the extrinsic value of the option decays. The seller mathematically benefits from the passage of time.
And if the option ultimately expires, worthless.
Then the seller's obligation vanishes, and that upfront premium becomes pure realized profit.
That makes sense. The clock really is the ultimate arbiter in both futures and options. Because unlike purchasing a physical stock, which you could theoretically hold in a portfolio for 50 years and pass down to your kids, a derivative is inherently temporary.
Very temporary. Every single contract possesses a finite lifespan, dictated by its expiration date.
And when that date arrives, the theoretical trading ceases, and the contract must be settled in the real world.
Traders must be hyper-aware of these dates, because failing to close a position before expiration initiates the settlement process, which takes two distinct forms. The first, and most logistically intimidating, is physical delivery.
This is where the abstract numbers on a screen suddenly manifest in the real world. Like if you hold a crude oil futures contract through expiration, the contract demands the actual physical transfer of those 1,000 barrels of oil.
Yeah, we are talking about coordinating freight trains of wheat, securing armored transport for gold bars, or arranging pipeline logistics for oil. Retail traders are entirely unequipped to handle this.
Yeah, I certainly do not have an industrial silo in my backyard.
Exactly. Consequently, retail brokerages employ automated risk systems that will forcefully close out a retail trader's open position just before the expiration deadline to prevent the logistical catastrophe of physical delivery.
It's basically a fail-safe to ensure I don't accidentally wake up with a train car full of live cattle dumped on my front lawn because I forgot to click a button.
Yeah, pretty much.
But what about the contracts that aren't tied to physical commodities, like our micro, E-mini, S&P 500 example?
Those utilize cash settlement, which is vastly more streamlined. Upon expiration, there is no physical asset to deliver. The exchange simply calculates the final difference between your contract's entry price and the official closing market price.
Okay, so if you're profitable, the exact cash difference is wired into your account. And if you took a loss, the cash is deducted from your margin deposit. It's just a purely financial reconciliation.
Exactly.
Which brings us to the most critical piece of architecture in the entire source text. Who is actually moving this money? I mean, if this is a zero-sum game and I make $10,000 on a trade, I am inherently relying on the losing trader on the other side of the country to actually pay me.
Right.
The entire system would collapse if losers could just refuse to wire the funds or declare bankruptcy.
And that vulnerability is known as counterparty risk. To completely eradicate this risk, the exchanges rely on the clearinghouse.
The clearinghouse, okay, how do they fit in?
The clearinghouse functions as the central, ultimate counterparty to every single transaction. When you execute a buy order, you are not actually forming a contract with another trader. The clearinghouse steps directly into the middle.
Oh, I see.
They technically become the seller to every buyer and the buyer to every seller.
So they act as a firewall. I never have to worry about the financial health of the person taking the other side of my trade because the clearinghouse guarantees the payout.
Exactly.
But wait, how can the clearinghouse guarantee hundreds of billions of dollars in daily volume without going bankrupt themselves?
They achieve this through the relentless enforcement of the margin system we broke down earlier, coupled with a daily accounting process called marking to market.
Marking to market?
Yeah. At the close of every single trading day, the clearinghouse audits the entire system. They adjust every single account balance to reflect the current market value of open positions.
Okay, so they don't wait for the expiration date to settle the score.
No, they settle the score daily. If your position gained value today, the clearinghouse immediately credits your account. If you lost value, they instantly deduct it from your margin deposit.
By constantly sweeping the accounts and forcing margin calls the second an account drops below the maintenance threshold, The clearinghouse prevents large systemic bets from accumulating in the shadows.
Exactly. This rigid daily transparency is the foundational bedrock that prevents the regulated derivatives market from collapsing under its own massive weight.
Wow. Okay, so zooming out from the mechanics of ticks and time decay, we have to look at the macroeconomic purpose of the system. Why does this complex plumbing exist at all for the global economy?
The source text outlines two paramount functions: price discovery and hedging. Price discovery is the natural result of millions of participants constantly bidding and offering, creating a transparent, highly visible consensus of what the market believes an asset will be worth in the future.
Which is data that allows a farmer to decide what crops to plant, or a manufacturer to forecast their operational costs for the next fiscal year.
Right. And hedging is the practical application of that data for risk management. Commercial entities use derivatives to offset catastrophic vulnerabilities in their business models.
Like the airlines from our intro, they're heavily exposed to fluctuations in energy markets.
Exactly. If a geopolitical event causes oil prices to double overnight, the airline could face insolvency. To protect themselves, they purchase oil futures, locking in their fuel costs today. Or consider an institutional fund managing billions in retirement accounts. They will purchase massive quantities of put options on the S&P 500.
Basically acting as an insurance policy to protect those portfolios against a sudden market crash.
Right, exactly.
It really reveals this fascinating symbiotic relationship. While a listener might approach this from the perspective of a retail trader focusing on speculation, leveraging a microcontract to capture a small intraday profit, that speculation provides the necessary fluid liquidity that allows the massive commercial entities to efficiently transfer their risk.
The hedgers rely entirely on the speculators to take the other side of their risk management trades. Without retail and institutional speculators providing that constant flow of capital, the commercial entities wouldn't be able to protect the global supply chains we all rely on.
It's incredible. Understanding this architecture, the interplay of margin as a performance bond, the mathematics of time decay, the zero-sum nature of futures, it isn't just a toolkit for active day trading. It actually gives you literacy in the secret language of how global economic risk is actually managed.
It really does. You start to see the invisible scaffolding holding up the prices you interact with every day. You realize that the cost of your groceries or the price of the gas pump is directly tethered to the efficiency of these standardized contracts and the clearinghouses managing them.
It's wild to think about. But, the architecture of that clearinghouse leaves us with a compelling final thought to chew on today. The entire source text praises the clearinghouse's daily marking-to-market routine as the ultimate safety net, ensuring the integrity of this massive zero-sum game. But this system was built on the assumption of orderly, measurable daily volatility. What happens if a truly massive, unprecedented global black swan event triggers a market movement so violently fast that the algorithms and daily margin sweeps simply cannot keep pace with the velocity of the losses?
Well, if the underlying asset drops faster than the broker can liquidate the accounts, the clearinghouse itself is left holding the bag. And if the central counterparty fails,
the firewall burns down. Does the ultimate referee actually possess enough capital reserves to survive an instantaneous catastrophic shock, or does the brilliant standardization we've been unpacking suddenly unravel? It is certainly something to seriously consider the next time you look at a supposedly perfectly regulated market.